The discussion about the short sellers, right? So short selling is not that prevalent, even though we discussed a lot about it, right? And then the textbook case or textbook role important role of those short sellers in making the market efficient, right? Hammering those, right, stock price in case there's a bubble, they have to hammer it out so that it will be, converging to the fundamental values, right? Well, short selling, in fact, it's not that much prevalent. Activeness of short selling is time varying. Sometimes, right, when the liquidity is bad, you don't want to short sell it, right? Liquidity, that, you have to have, enough of, trading volume to be able to short sell and then buy it back and things like that. If the liquidity is a problem, difficult to buy it back, you're screwed, man. You'll have to buy it at a huge premium. Anyway, only 30% of mutual fund managers in the US are allowed to short, and only 2% really short it. And individual investors are usually not able to short. Yeah, that's unfair. You will say it. Somebody say that. But is that really unfairness? Given that you've studied all those things, or it is really, really dangerous and risky. So that's why there is a reason why it is limited for the individual investors in doing that. Only 6 to 7% of lendable stocks are really lent for short sale, and lendable stocks take up only a fraction of the total shares outstanding. These are all research findings based on the US data, okay, by the way. And various rebate rate for short selling exist. Rebate is like a commission kind of fee kind of things in doing the short selling. 91% of stocks, well, when you short sell it, well, the fee is like 1% per annum, right? 1% per year. About 1% of the stocks are extremely special, extremely short sold, like the one you saw, GameStop kind of things, high short interest. Krispy Kreme, donuts, right? It's famous one even in Korea. Palm Computer, they were once short sold heavily. They were special. We call it special, right? And then the rebate rate was about 50% or 35% respectively. The short rate, time varying, right? Depending on the demand and supply in the market. Now, stock lending fee is high for small stocks and illiquid stocks. And of course, it's about the demand and supply again. Every now and then, the financial regulators impose a short sale ban, like in Korea. Oh my God, they are so lame in this short sale ban kind of things. Like the South Korean government or financial supervisors, they are swayed by the politicians in stupid ways. You never know what you're gonna get. Short sellers are painted as public enemy, which makes your life tougher. And short sales cost consequences, of course, the not just public enemies, but domestic institutional investors in Korea, right? They don't short sell that much compared to foreign short sellers, foreign institutions like Goldman Sachs versus 삼성증권. Which one do you think would short sell more frequently? Goldman Sachs, by far. Why? If you think that Goldman Sachs short sell more frequently than Samsung securities, simply because they are foreigners and foreigners are bad for a domestic stock market, you are heavily biased against, or you're more xenophobic. Okay? The thing is, domestic institutional investors, they have a reason why they cannot short sell that frequently. Why? If they short sell frequently, just as much as they wish, guess what will happen? They are under financial supervisory of Korean government. And the government official will investigate you and say, oh, you short sold. And then the public enemy you are. And then they will give you such a hard time, like 세무조사 한번 해보시겠어요? It's like a tax, IRS, all these kind of, trouble givers will bother your company, Samsung. Okay? In contrast, Goldman Sachs or foreign institutional investors, they are free from this kind of, not free per se, but they're rather flexible. They are not much of an under investigation or under heavy supervision. So they have more degree of freedom. Okay, degrees of freedom over there. So you need to have a correct picture in your mind. Foreigners short selling, it's not because of, this typical xenophobic reason that you want to see it in the news media, but because of the regulatory issue. Okay, domestic regulators, they work only on domestic institutions. You don't want to give trouble. You don't want to invite any trouble from them. 감사 한번 받아보시겠습니까? I mean, if some of you guys have experience in military, right? Army service. And remember your days when you had to go through those, how do you say, 감사? Auditing, right? 군단 감사 한번 떠보시겠습니까? It's like once the regulators comes in and investigate every nitty-gritty detail of your behavior, huge trouble, okay? You can't do anything. The thing is, the regulators are stupid. So that's why they are driven by the stupid politicians. I'm not saying that the regulators themselves are brickhead or anything, but because they are driven by, it's like a robot, works like a robot of the politicians. They are stupid. Okay, so that's a problem. Anyway, short sale cost, consequences. The prediction is that if short selling is hard, stocks can be overpriced. Okay. Why? The bubble cannot be killed. Nobody's hammering the bubble. So that's why. Okay? What's the consequence? Well, arbitrageurs' demand curve is steeper on short side, and then the negative opinions are not impounded into prices. And then every now and then, this kind of stocks with the bubble, they will face a crash, huge crash subsequently. In any case, you will see a market correction later on. But how frequently does it come, in what magnitude is a problem? If short sale is limited, then the magnitude will be huge. The frequency will be less, but the magnitude will be huge. In contrast, if the short selling is you can short sell those stocks, it will be hammered every now and then the crash, minimal degree. Okay, that's what we call market efficiency. Anyway, evidence is that Charles Jones of Columbia and Lamont, their papers show that the low book-to-market stocks are more likely to be shorted, okay, which means what? Growth stocks, right? Shorted stocks, and those that are particularly expensive to short have lower returns, okay? Lower returns because of the crash concern later on, right? And then the short horizon for those investing their own wealth, right? Horizon determined by the wealth, risk aversion, and etc., etc. This thing matters, right? Investor horizon. You've seen this in the movie, The Big Short, right? However, many arbitrageurs are investing their people's money. And what if those owners, right? The 전주, original investors of your hedge fund, if they I want my money back right now, and you're in trouble, okay? Hedge funds, mutual funds, and pension funds, you have to be concerned about the owner or the shareholders of your funds. And then trades require specialized knowledge, and then the money comes from outsiders. And then this separation of brains and capital also limits those arbitraging by affecting arbitrageurs' incentives to take long-term bets. So taking a long time, or how do you say, long horizon short, okay? That was really, really, how do you say, in the movie, right? That kind of thing was like really rare, we should say. 1 year, waiting 1 year or more. Come on. Empirical evidence is that if arbitrage risk is important for mispricing, there is a prediction. Anomalies that we saw earlier should be particularly large in hard to arbitrage stocks. Limits to arbitrage, we say. Okay, limits to arbitrage. And then limits of arbitrage. Which way? That preface, I don't know. Okay, go ahead and attach it. Limits to arbitrage. And then common practice for hard to arbitrage is like whether the stock is small or not. Stocks with high idiosyncratic volatility or not. And then the stocks on specialness, right? Small stocks is noteworthy. Typically, if you read the newspaper about short sellers, I mean, cursing all those short sellers and blaming everything, right? Those interviews upon individual investors, they always say, "Oh, I screwed my investment performance got screwed because of those short sellers, bad short sellers. These guys are especially bad, especially they are price manipulating for small stocks. And then I was one of the victims," they say it. But the thing is, on average, they don't short sell the small stocks in the first place that much. No way. Why? Because of the liquidity concern and limits to arbitrage, difficult to borrow those stocks. Then why do these individual investors blame short sellers? They have no clue. Self-attribution bias. They have to blame somebody. It's a blame game. That's the thing the news media never tells. Why? Because they have to flatter the CEO. "Oh, you're a great guy," and the short sellers are bad guys. That's the thing. Now, idiosyncratic volatility puzzle has been found, and that idiosyncratic volatility puzzle is something I have to explain it right now, and then it's connected to the limits to arbitrage. Okay, now you must remember one of the fundamental principle in finance is high risk, high return. Remember, risk-free investments, you don't require too much of a return, just risk-free rate. The bottom flat rate, right? RF, if it is risk-free. But if it is risky, then I want to get compensated more. I want some risk premium as long as I'm taking more risk. And that was the basic idea of CAPM and portfolio theory, all these kind of things, right? And then especially we learned that those high risk, high return holds true, especially for systematic risk. In CAPM, we had market risk, right? Higher market risk for a certain stock, Tesla, let's say. Tesla's market risk is big, which shows up in their beta, okay? Then the investors require a higher return for Tesla. That's the idea. Systematic risk, high return. What about the firm-specific risk or unique risk or idiosyncratic risk? That's the same thing, right? Firm-specific risk. For example, CEOs smoking a crack and then doing something crazy. Or CEOs bring those baseball bats and beat some people out there. Crazy. That's firm-specific risk. What if another example of firm-specific risk is labor union? What if the Hyundai Motors, right, extremely militant and they try to abolish and then destroy everything, right? They just like striking. Then that's a firm-specific risk. Not every car company have that kind of crazy labor unions, right? So if you have that kind of, firm-specific risk, does it get compensated? Is your expected return a function of idiosyncratic risk? And the answer is no. The answer is no. Okay? Why is that the case? Because of the portfolio theory. Those firm-specific risk gets washed out as you form portfolio, diversified portfolio. For example, if Hyundai Motors labor union strikes crazily, like what you've seen like a week ago, Minnochong, right? And then bad news for Hyundai Motors, the price will go down. But the thing is, as long as you hold a diversified portfolio and then maybe you have a competitor stock, let's say Toyota Motors. Oh, Hyundai Motors going bad. Well, that's a good news for Toyota. And then you have both stocks. So they cancel each other out. So as a portfolio managers, right, completely rational investors, you don't care about those firm-specific risk. So the idiosyncratic risk, it should not affect your expected return, okay? The company's expected return. That means the Hyundai Motors expected return. So that's the idea. Idiosyncratic risk the same thing, idiosyncratic volatility. Interchangeably, we use it, right? So this one, idiosyncratic risk or idiosyncratic volatility, should not affect the future return of the stock. But is that really the case? Okay, is a valid question. And as it turns out, Andrew Ang and his research team investigated this question and using US stock markets big data. And then what they found is that, oh, that's not the case. And in fact, the return, future return, seemed to be a function of idiosyncratic volatility. And that's surprise number one. Surprise number one. Idiosyncratic volatility seemed to affect future return. That goes against our Nobel Prize winning theory. What? Idiosyncratic volatility puzzle. Okay? Number two surprise is that, interestingly, high idiosyncratic volatility or a high idiosyncratic risk, then low future return. Shouldn't it be high risk, high return so that you want to get compensated more? But it's the other way around? I don't get it, right? So people got like, what the heck was found? Hey. So that's their puzzle they reported. And then this is their table in their paper. And people have been trying to investigate why do we have idiosyncratic volatility puzzle like that. And one of the more convincing explanation, most convincing one, came from my professor Yu, right? He used to be a professor at Minnesota, Jianfeng Yu, right? Chinese genius guy. He's in Tsinghua University now as a professor, and then graduated from Wharton, and Stamball was his academic advisor, and they were having papers together with it about idiosyncratic volatility puzzle, and they link it to the limits to arbitrage. What's the idea there? Well, those stocks, right, with high idiosyncratic volatility, they are too risky to short sell. They are typically difficult, small stocks, and they typically don't get shorted frequently because those hedge funds feel risky. Just like GameStop. What if we get squeezed, or what if we, suffer from noise trader risk, right? Short sold it, but later on, it just price goes on up on the other to the opposite direction, right? To your expectation, and you have a hard time buying it back. You're screwed, man. So this kind of small stocks or low liquidity stocks, and especially this kind of small stocks, they suffer from high idiosyncratic risk. The CEOs can do whatever, and crazy things over there, or the labor unions. They bring all kinds of various unexpected outcomes, right? So in those small companies or high idiosyncratic volatility stocks, not much of a short selling goes on. Okay? And that lack of short selling incurs bubble. Okay? Lets the bubble happen. The hedge fund managers can't do anything about it. So what happens subsequently? Well, it crashes subsequently. Much more than big stocks. Small stocks, right? Much more crash than big stocks because of the limits to arbitrage in the first place. So what's the consequence? The future return, more idiosyncratic volatility stocks, difficult to arbitrage, so more crashes subsequently, and then the future return turns out to be much more negative for this kind of high idiosyncratic volatility stocks. That may be why, this kind of idiosyncratic volatility puzzle is present. And that kind of puzzle, right, is much more pronounced during the bubble period, right? So asymmetric arbitrage, they find, right? Short selling, well, it is a high cost and then there is intensive regulation. High idiosyncratic volatility stocks, well, the number of overpriced ones are much greater than the number of underpriced ones because of the limits to arbitrage, limits to short selling, right? Bubble, and then crash, especially for high sentiment period, high bubbly period, right? And then subject to crashes like that. So what you see over here in this graph, the horizontal axis, what you see is mispricing level. The periodically, these, right, the leftmost side are the periods of bubbly period. When you buy these stocks and then see the future returns, especially you buy the stock during the bubbly period, what happens to the stock going into the future in the return wise? That's shown over here. And then less bubbly period, and then crash period. This is the trough or bottom of the stock market. Okay, bad sentiment, good sentiment, bubble and crash. So if you buy the stocks at the bottom of the sentiment or crash time, then subsequently it's a trough, subsequently it goes up. Okay, so if you back test those things, the return shows like this. Bad times, crash times, subsequently price goes up. Good times, bubbly times, that at the peak, the price will go down like crazy. The bubble crashes like this. Okay, so at the bottom, going the other way around, bouncing back. Good. Now for each group, what do we see? 1, 2, 3, 4, 5 groups. Well, that's idiosyncratic volatility sorted groups. So this darkest one is the lowest, smallest idiosyncratic volatility. Firm specific risk is the minimal for these stocks over here. Okay. And on the other hand, these stocks over here, these are the ones with the highest idiosyncratic volatility, like CEOs smoking a crack like crazy. All right. That kind of things. The thing is, you see more idiosyncratic volatility, then you see more drastic future return, either going down or up. Okay, but the magnitude is huge, the bigger for downside, the crash side. So higher idiosyncratic volatility stock seem to have more stock price, going down in the future. Okay, so that's why higher idiosyncratic risk and lower future return. The relations seem to be explained by this limits to arbitrage, and then depending on the market sentiment. That's the contribution of their papers, right? Very interesting one. Super genius, right? Anyway, other smart money trades are also there. In all cases, we've considered arbitragers are like that. The arbitragers, like, they trade so as to encourage and enforce price being equal to fundamental values like this. And then, but in some circumstances, the smart money trade may actually reduce market efficiency. Okay, so this kind of concern, I'm going to talk about it in the next video. So thanks for watching until now, and